Dear learners, now after looking at different key performance indicators in the supply planning scenario in our previous session, let's understand different KPIs in the step 4, that is pre-S&OP or financial reconciliation step. Now, there may be many measurements or many other indicators that the business may follow, but we are recommending 3 major key performance indicators that must be in your tracking sheet to measure the business performance in this step. Now, what happens in step 4? Basically, so far the demand plans are ready. We have demand numbers, then supply plans are also ready. That means we have supply numbers. But there are very rare situations where demand and supply plans are actually matching easily. Okay, and that's why the pre-S&OP or financial reconciliation step, or step 4, comes into the picture. What happens here? In this particular step, we try to align demand and supply plans with financial targets. We also evaluate the revenue, cost, and margin impact when the supply plans are getting changed. Then we run multiple business scenarios to understand which scenarios would be better fit for meeting the customer demand. And finally, we select best or balanced plan out of this particular meeting. Now, first, an important metric that is measured is revenue forecast accuracy. Now, the formula for this particular method is as similar as forecast accuracy, but it is talking about revenue. So, formula is 1 minus, bracket, then absolute of actual revenue minus forecast revenue, then divided by actual revenue. Okay, so in this particular metric, we actually understand the accuracy of demand and supply plans. Now, what is the assumption? Let's assume that we forecasted that our sales will be $95,000 in the particular month, but actual sales that is generated is only $88,950. Now, when we put these numbers in our formula, we get that 93% is our revenue forecast accuracy. Having higher accuracy is better for the business. Now let's move to the next metric, which is inventory value variance. So we have already seen that in the supply planning step, we also plan how much inventory will come into the factory or in the warehouse facilities. But since that is also a forecast and planned numbers may not actually realize in the reality, sometimes you may get more inventory or sometimes you may get low inventory. This planning is important considering the cost that we are putting into the inventory, or basically, it is also important to plan because we may have shortage of the space in the warehouses to store the inventory. And that is why inventory value variance is also important to understand the business performance. The formula for this metric is actual inventory value minus the planned inventory value. And what it tells us is all about financial impact of inventory imbalance. Now, let's assume that the inventory forecasted was around $22,000 for that particular month. But in an actual, the actual inventory by end of this month was $24,200. And that's why it tells us the variance is $2,200. So the variance should be as low as possible, which tells us that we are on right track to plan our inventory and to get right amount of inventory in the business facilities. The next particular metric that we talk about is impact value of different scenarios. Now, we have seen that not all demand and supplies are aligned easily. Sometimes you have to do certain adjustments in overcoming your constraints. These adjustments could be adding extra labors or adding extra hours of work or extra shifts, or even installing new machineries or equipments, or even situations like leasing out third-party warehousing services to store extra inventory. This situation we had seen in our step 4 of our previous sessions. So in those scenarios, the supply cost actually gets increased to meet the demand. And that's where we have to check multiple scenarios in the step 4 meeting. And while checking, we have to also see the impact of that scenario. Now, there is no specific formula for that, but it is simply checking how the return on investment is getting impacted when your supply capacity is having constraint, and when we have to increase that capacity with certain expenses. Okay, so what is meaning? It tells about the financial comparison of demand and supply options, and to simplify the understanding, let's take our old example from our step 4 session. In our Step 4 pre-S&OP meeting, what we had seen that there would be extra expenses of $36,500, and these extra expenses are basically to cover the extra demand of 450 laptops, and each laptop is giving revenue of around $800. So total revenue we are getting is around $360K against the expense of $36,500. So when we compare that with the return on investment, we basically understand how impactful will be the extra spend that we are doing for the businesses. And this metric talks about whatever cost we are incurring in meeting the customer demands, whether it is making sense or not. So that's all about our step 4, and stay tuned for the next steps.